Right, then we get to this anti-avoidance provision, and it's an anti-avoidance relating to donations tax, talking about the cession of a right to receive an asset. So what was stated in the budget speech is that schemes have been devised to transfer rights to asset to a trust before any value attaches to the right, thereby avoiding both income tax due to the inclusion of the value of the asset in gross income and donations tax, which would arise on the value of the asset donated to the trust. So the way that these schemes work is that we would have somebody rendering services to somebody else. It could be an employee or an independent contractor. And the person is rendering the service, and they are going to be remunerated, if you like, in the form of receiving an asset. But the value of that asset would be would sort of develop as these services are rendered. So at the outset, before the services have been completed, the asset, there's a right to receive an asset, but there's no value at that point. Once the services have been rendered and we sort of have reached the full fruition of this transaction, then of course there would be a full right, a full value on that asset. But the idea here is that the person cedes that asset to somebody else, and it's typically a trust or a family trust, before they have completed these services and while there's still no value attached in that asset. And so that way there is the sidestepping of donations tax. And so not just donations tax, but then by the time the person has completed the services and they're due to receive this asset, the value of that asset has been ceded. But remember that paragraph C does provide that included in gross income is any amount received in respect of services rendered. And section 7 does also provide that the person rendering the service is the one in whose hands that value will be taxed. But the main issue here really is a donations tax issue, because the point is that at the time that the right to receive that asset is ceded, there's no value attached. So what they have brought about is this new provision, section 57B. So section 57B, obviously that's sitting within the donations tax provisions of the Income Tax Act. And it applies where a person agrees to render services to another person. Now here, they talk about the employee and the employer, but it's for the purposes of this provision. As I said earlier, this can be a true employee or an independent contractor who's rendering services to somebody else. So they just refer to it here as an employee, but it's not necessarily limited to the definition of employee as you would understand it, let's say, for employees' tax purposes. Okay, so it's the person rendering the services to the other person that we call the employer in this situation, where the whole or part of the compensation will be paid in the form of an asset. And prior to the employee becoming entitled to the asset, that person disposes of the right to another person. Okay, so it's contemplating that situation where you dispose of the right to receive the asset before the asset has actually accrued to you. But the point of the matter is that the value of the asset, there is no value in the asset at that stage. So there's no donations tax as it would stand, but that's where section 57B is going to come to the rescue, as it were. So what section 57B does in terms of subparagraph 2 is it tells us to disregard the disposal of the right itself. That in itself has no tax implications, but the employee is treated as having acquired the asset on the date that it would otherwise have accrued apart from the fact that the cession has taken place. And the value is going to be the value that would be included in the person's gross income. So let's say this person starts the contract on the 1st of March next year, and the asset only accrues, the services are completed and the asset accrues, let's say, at the end of May. Now, at the end of May, the asset has a value of, let's call it R1,000,000. 1st of March, it had a value of nothing. So what we're saying is that that value that would have accrued had the cession not taken place, that is the value of the asset, and the employee is treated as having disposed of the asset to the other person by way of donation, and the amount of the donation is that amount of R1,000,000. Okay, it's equal to that expenditure referred to in paragraph A. So we've now got this donation that does have a value, and donations tax will be levied. That R1,000,000 also then becomes the base cost in the hands of the recipient, so the person to whom the asset has been ceded, the family trust, they will be regarded as having acquired the asset for that same amount. All right, so you've got the amount that comes into the gross income, R1,000,000. You've got the donation of R1,000,000, and the other person is deemed to have acquired the asset for that amount of R1,000,000. Okay, so that's the anti-avoidance that comes into effect there, and that will take effect again from the beginning of the next year of assessment, 1st of March 2022.